Hong Kong is working towards becoming a global center for cryptocurrencies, even as places like the US remain cautious about the industry. In June, it introduced a license system to oversee cryptocurrency exchanges that trade Bitcoin and Ether. This is to lure capital and skilled people back to the city, which had previously been impacted negatively by strict COVID-19 measures and political unrest. The response from digital currency companies has been mostly positive, but big investment commitments are still lacking. However, it seems that Hong Kong's plan is discreetly supported by Beijing, even as mainland China continues to enforce a cryptocurrency trading ban. 1. What is the new regulation? The new laws state that everyday investors can trade cryptocurrencies on exchanges licensed by Hong Kong's Securities and Futures Commission. The city emphasizes that consumer protection is significant, imposing stringent requirements on which virtual assets can be traded. Factors such as how long a cryptocurrency has been in circulation, its market value, and its average daily trading volume must be considered by platforms when deciding which tokens to offer. The cryptocurrencies must also be listed in at least 2 prominent cryptocurrency indexes, one of which must have traditional finance background. Furthermore, the Commission requires that cryptocurrency companies set up additional safety measures before accepting clients. These measures include checking whether customers understand digital assets before they invest, and establishing trading or position limits based on the customer's financial circumstance. 2. Why is Hong Kong embracing crypto? Hong Kong's policy pivot is part of a wider effort to restore the city's credentials as a cutting-edge financial hub. It's a reputation that was put at risk by years of strict COVID-19 restrictions and political unrest, which caused the economy to slow and talent to leave. Financial Secretary Paul Chan called cryptocurrencies and other virtual assets unstoppable new financial innovations at an event organized by the Hong Kong Association of Banks in November last year, and said there's a need to embrace them. The government has allowed exchange-traded funds investing in CME Group Bitcoin and Ether futures, and sold its inaugural digital green bonds, which use digital ledgers to make the settlement and coupon payment process faster. 3. Is this Hong Kong's first foray into crypto? Hong Kong used to be a digital asset center in earlier years before taking a more skeptical stance. Exchanges including FTX and Crypto.com, previously known as Monaco, were founded in the city. Prior to the new regulatory regime, the SFC had a voluntary licensing program. Only 2 exchanges, OSL and Hashkey, opted into that legacy framework, which permitted them to provide services solely to professional investors with portfolios of at least 8 million Hong Kong dollars, $1 million. The rules came after mainland China told platforms to stop trading in cryptocurrencies and banned initial coin offerings, or ICOs, in 2017. The mainland barred crypto transactions and pledged to root out mining of digital assets in September 2021. 4. What impact does mainland China's ban on cryptocurrency trading have? There's a chance that China's cryptocurrency prohibition could influence semi-independent Hong Kong. But Hong Kong's authorities disagree, noting the one country, two systems rule that allows Hong Kong to control its own economic and political systems. Moreover, there are indications that Beijing might be silently approving Hong Kong's actions. China's liaison office representatives and other officials have been seen at cryptocurrency events in Hong Kong, according to insiders, and they behaved in a friendly manner. This subtle support might suggest that China is interested in using Hong Kong as an experimental zone for digital currencies. However, China has shown no signs of easing its strict control over the domestic crypto sector due to worries about consumer safety, possible use of crypto to bypass capital restrictions, and the environmental impact caused by Bitcoin mining, which uses a lot of electricity. 5. What are the remaining obstacles? Crypto businesses face several challenges primarily due to unclear regulations. The Hong Kong Securities and Futures Commission, SFC, hasn't provided explicit guidelines for certain new FI sectors, such as decentralized finance, derivatives, and staking concerning digital assets. Non-fungible tokens, NFTs, and utility tokens used for games that pay players real money also don't fall within clearly defined regulatory boundaries. So, firms that operate in these areas must figure out if their services are considered securities, which would cause them to need a license. This is a complicated task, as the SFC has said it will handle these cases individually. Getting access to banking services is another hurdle. Crypto companies must comply with strict customer identification and anti-money laundering rules. To address this, Both the SFC and the Hong Kong Monetary Authority have been encouraging banks to offer services to licensed crypto businesses, even organizing meetings for this purpose in April and June. Lastly, finding suitable employees is a challenge. Particularly, there's a shortage of responsible officers who handle compliance for licensed companies. Hiring institutional-level crypto traders and developers is also proving difficult. 6. How has Hong Kong's shift towards cryptocurrency been received? Hong Kong's move towards cryptocurrency has caught the attention of both local and foreign firms due to the potential it offers as a channel for Chinese wealth, especially if China relaxes its digital asset restrictions. Some firms like Hobby, OKX and Amber Group have expressed their interest in obtaining licenses, although significant investment commitments have not been made immediately after the new system was introduced. It's uncertain whether these new rules are enticing enough to prompt heavy investment. The emphasis on protecting retail investors might reduce profitability if activities like margin trading, staking and derivatives continue to be unavailable. Furthermore, the global cryptocurrency market is still recovering from a significant decline of $1.5 trillion last year.